Hey there, Casey Dim at TaxSaleAcademy.com, and welcome to this week's Tax Sale Question segment. This week's question comes to us from Eddie on YouTube. It says, heard I can just pay someone's taxes for 7 years and get the property. True? Question mark. Eddie, first off, thank you for your question. The short answer here is no, absolutely not. This floats around from time to time, and it's related to something called adverse possession. But that was not a law intended to simply allow people to pick a property off the tax roll, pay their taxes for a number of years, and then say that they are now the owner of that property. There are many parts to an adverse possession claim. There's lots of requirements. The time periods vary from one state to the next, and it will lead to court proceedings in nearly every case. But here's an example of when something like that would apply. Let's say that you inherit a property from your grandfather that he purchased back in the 1950s. You move your family there, you live on it, you pay taxes, everything looks good. Then out of nowhere, like 10 years later, somebody comes up to you and says, listen, your grandfather really did not own that property because I found a deed and a storage unit where the person that sold it to your grandfather actually sold it to me first back in 1945. Now, because you have been using the property, because you've been paying the taxes, because your family's used the property, and many other aspects of the law apply in the situation, you would have an adverse possession claim. That's the premise of the law. It's not just simply choosing to pay somebody's taxes and becoming the owner of that property. Obviously, you could give that a try if you wanted to. It's probably not going to work out well for you. You actually have a number of properties I'd be more than happy to send you the tax bill on, but it just does not work that way. The issue here is that many people confuse this myth of just paying somebody's taxes to get a property with the legitimate tax foreclosure systems that are used by counties and mandated by state statute. Now, depending on the state, this could include tax liens, tax deeds, redeemable deeds, or hybrid systems. And essentially, in all these, you have an owner who did not pay their taxes on time, and then once they're late, they have the opportunity to pay those late taxes back plus interest to either the county or the tax lien holder. And then after all this time passes, if they still don't pay, they do lose their property. Obviously, there's a tremendous opportunity in that, and that's what this entire channel here on YouTube is about. But what a lot of people do is they kind of confuse the two of those things with just paying somebody's taxes against the property with the legitimate tax foreclosure systems. So don't go out there and just start paying properties off the tax roll. Instead, go through the proper channels, the tax liens, tax deeds, tax foreclosure systems that we have that exist throughout the United States. So, Eddie, hopefully this answers your question. If you have a follow-up question or anybody watching this video has a question, feel free to leave it in the comments below this video or any of the videos that we have here on YouTube. And I'll definitely respond to it. I might even record a video response just like this one. And for more information about the tax sale business, make sure you check out my book right here, Tax Sale Playbook. You can get this book at TaxSaleBook.com. The book itself is free. I bought the book for you. Just cover the nominal shipping and get it from our warehouse to your front door, which is less than $5. Again, that's TaxSaleBook.com. Take care, folks. Bye-bye.